Average length of haul keeps falling, maybe due to e-commerce. We talk about M&A in the transportation industry and how the new tax reform is affecting truck orders. I'm JP.
And I'm Zach.
And we're actually at the McLeod CFO conference at the Westin in Nashville. So just covering the conference and went to some morning meetings for this bonus episode of What the Truck. Zach, let's talk about, first of all, Bob Costello's presentation, sort of, doing his thing, the sort of macroeconomics, but also looking at some of the really crucial KPIs for trucking. What kind of surprised you about that presentation?
Well, one of the things that stood out to me was the length of haul shortening.
Right.
The e-commerce, he mentioned e-commerce would really made a big impact in the overall length of haul. I think the average truck was under 500 miles now, which was the first time that's happened.
Yeah. It seems like it's been falling steadily ever since the Great Recession. And just to dig a little bit deeper into why e-commerce would affect length of haul. I mean, he said something like, 10 years ago, a big box retailer might have had 4, 5, 6 major distribution centers in the United States, and now they have dozens.
Yeah, I think one of the, obviously everybody's going to start thinking the Amazon effect that we've talked about to ad nauseum.
Right. This is like a different facet.
Yeah.
A lot of times we talk about consumer expectations with same 2-day delivery or whatever, but this is sort of looking at it from the other side, right?
Right. So I mean, now we have some sort of statistics on it. So we now have validation for this shortening of haul, which affects the supply chain throughout. I mean, that's when you're talking about going from a big box retailer to somebody who's clicking an order online now, those stores really take up a lot of space.
Right.
The whole logistics of just delivering to these big box stores is kind of a thing unto itself. When you're going and bumping docks at these stores, they don't have a lot of warehouse space.
Right.
So they only want you to have so much truck. That affects LTL. LTL is kind of, the retail box stores is kind of what they do. So when you're talking about this contraction of supply chain networks, it has huge impact throughout the industry.
And we also talk about the Amazon effect. Obviously customer expectations about fast service, quick deliveries, easy returns, extremely cheap shipping. But I think we have to keep in mind, when you talk about shortening delivery times, you're talking about shortening length of haul. You can't get one without the other, right?
Right. No, exactly. And so when you're this has a double-edged sword. It's actually good and bad at the same time. So you're gonna reduce the amount of miles available for drivers to drive. So that's going to cut into their pay a little bit. But it also kind of makes them more efficient. So
right.
They're going to have these shorter length of hauls. They're going to be home more.
Right.
There's going to be more of probably a regional distribution instead of an over-the-road,
right.
which I think most drivers in the industry are preferential to.
Yeah, it's when I think about trucking company earning reports and the sorts of things they talk about. One of the things they talk about is miles per week, which if you're trying to increase your miles per tractor per week, you're sort of swimming against the tide. But when you think about things like driver retention and the fact that lots of companies, their irregular over-the-road segment of their business is the least profitable, actually. If we can transition more to regional, more to these sort of line haul moves, I think it could be better for the drivers. It could be more predictable for the carrier. There's upside here.
I think you're right. I think there's tremendous upside. I think what you're going to see is maybe a reduction in average miles per truck, but also an increased load count. So you're probably going to have more loads,
right,
to kind of offset that. And it's going to be in a regionalized network, so it'll be far more efficient and easier to manage. The over-the-road,
predictable.
Exactly.
Yeah.
When you're talking about freight networks in general, when you're talking about managing 800-mile hauls and figuring out how to keep them in balance,
Right,
you know,
right.
where's my next load going to be? Like 800 miles away, you're probably going to deadhead into something. When you have these regionalized networks, they turn into these hub and spoke type setups where
Right.
you have these regionalized distribution centers, and they service a specific area. So your drivers are going to be more efficient at driving in those lanes as well.
Right. That they know well, and they know exactly what they're doing. They're in and out, and they have the delivery times become more regular. In theory, at least, shipper and customer performance at the dock could be rationalized in some way. So some interesting takeaways from just that one metric from Bob Costello, the chief economist of the ATA's presentation. The other cool panel that we saw was all about M&A, mergers and acquisitions in the truckload space. Lots of things just from, Larkin was on the panel, Renee Krug, the CFO of Global Trans, which is a big 3PL that just got bought by the Jordan Group. Someone from Dasky was there. Lots of different sort of perspectives on what this space looks like in the current kind of inflated environment. And it was interesting. It was interesting also to hear about the process. But let's just go into what do you think about what Larkin was saying about what the environment for these deals looks like right now?
Yeah, I mean, I think one of the interesting things that he pointed out was the fact that asset light is still the most attractive to investors in terms of the higher multiples in terms of purchasing and merging these companies. And
so the idea is that you buy a small asset light company for 4 or 5 times EBITDA, and then you grow it, turn around and sell it for 10 to 14.
Yeah. The idea is that you compile all these asset light companies together. Smaller brokerages typically are in that category, so they'll put them together, and then once they get to the multiple they want, they turn around and sell it for multiples. And
so asset, so that makes sense. So why is asset light? Why is it easier to do that than with an actual truckload carrier with several thousand tractors?
Well, that's a good question. The asset light doesn't have the exposure to the economy like the heavy truck carrier does. They have all this equipment and infrastructure that they have to support, whether the economy or the freight's moving or not. So when you're talking about asset light,
no matter what the rates are doing,
exactly. Like the economy tanks, the trucking company is exposed to equipment utilization problems. The broker doesn't have that.
Right, because then so it's interesting because since we've been doing this podcast, we've been in a tight capacity environment where the brokers are always begging to find trucks, right? But when the economy tanks and demand and supply go out of balance, the brokers aren't exposed. They just turn around and say "Oh, now you need loads," right?
Exactly.
They're playing the other side.
The broker just turns their head to the other guy. Like right now, when the economy's great, the broker turns to the carrier and says, "Hey, man, what can I do for you?"
Right. So it seems like that's an obvious reason why asset light companies enjoy much higher multiples.
Exactly.
What other things was Larkin saying just about valuations right now, and what it's like on the seller side?
So one of the things he really pointed to was the fact that even the heavy asset guy is actually getting a better deal right now.
Right.
In the market. It's contracting. The difference between the two has contracted a little bit because the economy's doing so well. So the market is ripe for M&A, but of course everything's so expensive. So
right. The other really interesting thing that I thought that he was really sort of bringing his expertise to the table, kind of giving advice to companies who might want to do a deal, and they go to market, or they go into this process, thinking how it's going to go, thinking, trying to anticipate what would look good on their books. But he was sort of saying don't think that okay, this quarter is a little soft for you for some reason, it'll be better next time, and you're put off a decision. He's like, don't wait to make operational changes because of how you think it might affect the books. And your sort of proposition.
He definitely hit on some solid points, and it speaks to integration and things of that nature, where basically, if you're ready to make a sale, or you're going to sell, or you're going to purchase, like, don't put off those decisions till later. Like, you want the company to run as efficiently as possible. Right. So if you
need to add, C-suite people, make changes, that sort of thing, just run your business.
Yeah, you need to run your business, and that's one of the challenges that they were seeing actually is, if they didn't make the proper preparation, like, it really kind of actually hurt the sales process. So they could actually bail on the deal if you weren't organized enough to have your stuff in order. And so, like, you stop making your day-to-day decisions the way that you were doing it. That's the thing that put you there in the first place. So why would you stop?
I thought the whole thing was so interesting. Like, I didn't realize, so I know, like, obviously investment banks help put together acquisitions and sales, right? But when they went into, like, all of the different services that they offer in terms of, like, marketing, like, because ultimately, like, if you are trying to be acquired, you're selling your company, right? And they come up with all of that material. They, like, create this narrative, like the word story kept being used over and over again. Like, it's all about a story, because that's like sort of what makes sense to people, how they can sort of understand.
One of the things that kind of stood out to me is that they really did, it wasn't just a straight financial transaction. It was more about, like, what is this company's culture? Like, they spoke to that a lot, and they look first at the leadership team before they look at the financials even. And they, it's one thing to have, like, standardized accounting practices and all that kind of stuff in order and go through the audit.
Right.
I mean, that's obviously part of it, because every company has something different to their whole process.
Right. We have to adjust this because of this reason.
Exactly, right? And having been a financial analyst, like, I get it. Like, there's certain days where I wouldn't do that same thing in another space, just because the situation changes. So it was cool to me to hear that they actually looked at kind of the culture and the people at the top.
That word kept coming up over and over again. Culture, like, is the company that we're looking to buy a right fit culturally? What do we mean when we say culture in terms of a business?
So culture, typically means, like, when you walk into a building or an office, you kind of get a sense of what they're about. Like, it's how they interact with each other. It's like, do they use manners? Do they use simple things like that? It's literally just the person-to-person interactions. Like,
interesting. Okay.
Does the CEO come out and talk to people freely? Are there a bunch of directors sitting there that are hammering down?
Right. And I would imagine that it has a lot to do with, like, okay, do you have, like, a core of like, long tenured people?
Exactly.
What are they like? How do they run the business? Like, do they like hire? For example, like, do they like hiring the best people they can possibly find, even if it might be better than them? Or,
I think I think the best example of culture in trucking is I think a lot of people have had experience with brokerage houses.
Right.
You walk into a lot of these places nowadays, and it's a bunch of a lot of 20-somethings that recent grads to, like, kind of young professionals.
You get places like Coyote, even like Convoy.
You walk in there and they're, like, in their shorts and t-shirts, and they're on the phones. Like, they're walking around. You've got, like, a cornhole board in the side, and it's a very loose environment. They're very comfortable where they are, but they're also, like, working really hard. I mean, on the phones. So it's kind of like this culture of casual but professional. Like, I'm here to work, but I don't have to, like, it's not this overbearing sense of, like, somebody's going to come over and, like, beat me up for.
Right, and so it's kind of like, say you're a giant, sort of buttoned up corporation, that's been publicly traded for a long time, and you run things in a certain way. Yeah. You might have, whatever, all these different kinds of policies, and then it's basically like, can you make this acquisition of all these, college kids who are, working 60 hours a week or whatever and drinking beer? Can you fit that into your business? Can you measure it the way you're supposed to? Can you make it perform and grow the way it's supposed to without losing the secret sauce?
Yeah, I mean, I think a lot of what brokerage houses are built on is energy, and so if you cut them off from their energy source, like, you're basically killing the company itself. Right. And I think that's one of the things that they were really trying to point to is, like, you cannot, like, absorb a company that's more traditional, you can't absorb this non-traditional kind of brokerage house into a more traditional environment and expect to get the exact same result.
Right. Yeah. I know there are a couple of recent large acquisitions that I'm thinking of where there were like glaring cultural conflicts.
And that can happen between the same style of business too. I mean, even between two trucking companies that appear to look the exact same on the surface.
Right.
You try to merge these two companies together, and you've got this traditional, company over here that, they go to lunch whenever they feel like. It's just something as simple as that. And
Right.
this company over here operates on a strict schedule.
Right.
You merging those two things can be catastrophic if
Interesting. Yeah. I mean,
don't manage
even
through
like companies like people clock in and out at one and don't at another one.
Exactly. It's like, no, I clocked in. I take care of it. It's fine. And everybody's cool with it. And then the other one's like, well, no, you were 1 minute after your time.
Right. Now we have to pay overtime, blah, blah, blah.
Exactly.
So that really, we started talking about culture. Now we're kind of getting to like sort of meshing businesses and culture. And I think, one of the questions was, what is the most difficult part of the merger and acquisition process? And the answer was overwhelmingly integration.
Yes,
like
integration.
one of the last parts of the puzzle.
Well,
so why is it so hard? What are the different like models that companies do, and how do we know if it's successful or not?
So we are at a CFO conference. So it's largely accounting and finance people.
Right.
So they're
as
primarily
opposed to HR or marketing
right.
or who also have to deal with integration.
Exactly, and the level of integration they were really talking about is kind of what we talked about earlier with accounting practices and things like that. Like when you're talking about integrating data together, like that is
Right.
a very, very difficult process.
Right.
You could have two.
What did you add and subtract to this number before you put it in
Exactly.
the report? Like, how do we undo that or adjust it to what we want? And it's just like, hundreds of thousands of tiny little adjustments, right?
Exactly, and in accounting, you have to balance the books. Exactly. So
that sounds terrifying.
It is. It's actually a very, very trifling process. So, say for instance that there was a credit that they had to take back in June. Well, that affects like the books moving forward. So
Right.
then there's this waterfall effect of rebalancing everything out. But they can't take it in June because that book's already closed. So now they have to go through and reassemble it in whatever order they want moving forward, which is a very tedious process, especially when you're talking about, I think another layer of integration they were talking about is just KPIs, the way that they viewed certain operational numbers and stuff like that.
Right. And like what exactly the executive team is trying to achieve. Like what numbers do they care about?
Exactly.
Which ones are they trying to push forward? And even companies in the exact same business have different models.
Yeah, they look
and sort of butter their bread in different ways.
Exactly, and they may measure it totally differently than you would imagine that they would. I mean, it's hard to imagine that your miles per truck could be measured differently, but they could chop it up. I mean, there's all sorts of ways you can turn numbers, but you have to come to an agreement to make sure they're all lined up. And then you could totally go all the way into the IT, the infrastructure situation, which is a whole nother just...
Right, and it's really interesting. The whole sort of problem of integration and like how much you're trying to integrate. Whether you're trying to find synergies of scale, like what exactly that looks like. It's fascinating because even though we're in like an incredibly robust freight environment, as Costello said, the second longest economic recovery in U.S. history. I think probably 20th century. Like it's still difficult because of the driver shortage, and we can get into that too. It's difficult for companies to like grow organically, right? I mean, you get it with price action, you get it with margins, but you can't just add so that's why we're talking about M&A. It's because that's one of the best ways to grow in this environment is just buying other companies.
Oh yeah, it's definitely the easiest way to grow. I think anybody that wants to grow fast.
Well, it sounded kind of hard. from what they were. I mean,
oh, it's difficult. It's insanely difficult.
You can get a big number
Yeah.
quickly,
Yeah.
but there's lots of risk.
Exactly. So you go out and you purchase a company, and just like all the points we just hit on, integration, culture.
And depending on how leveraged you are, I mean, right now, we kept hearing that, the cost of capital is has been artificially low for a long time. That's probably starting to change. As the Fed gradually inches up the rates, but yeah, it's like you can, especially if you're publicly traded, like you can, your investor, your shareholders will like the numbers they see if you go on a buying spree. Usually.
No, you're right, and it's very hard to kind of do that all at once without, like, because you're buying new trucks, but you can't seat them fast enough.
Right.
If you build up a network of 10 to 15 more trucks, but you could go out and easily just go and buy like a company that had 20. And all of a sudden, they're already set up in their own networks. You're not piecing together these lanes and these customers that you have to do to fill.
And all of a sudden, your revenue just got a step change.
Yeah.
That's one thing that we sort of forgot to talk about with Costello's presentation was the driver shortage. He was saying, and this is a point that is hammered into consumers of transportation media on a daily basis. The ATA estimates there's a driver shortage of about 51,000 drivers, in the for hire heavy duty truckload segment, as opposed to the 10 million CDL holders. He kind of went through all that.
Right.
He's talking about 51,000 driver shortage on a base of 500,000. So call it 10%, right?
Right.
And it's and he said if nothing changes, that could grow to 176,000 in whatever by 2030 or whatever it was.
Which would be a massive situation.
But how do we know how many drivers were short?
I don't think we do. I think we can estimate all the time, but I think actually what's happened is a lot of I think it's really a large carrier driver shortage is what we're talking about in most cases.
The retention issues, and he was saying that they're making progress on that. It was like 80 or 90% turnover, which improved. Is somehow an improvement. But my question is like, what would the trucking economy look like if we didn't have a driver shortage at all? Like, is the goal to get truckload like rate per mile equilibrium? Because
right.
do these companies actually want that? No. Right? Is the goal to stop driver wage inflation? In theory, yeah, they want to do that, but
it's not. That's not going to happen. I've been in the freight market where there was a driver shortage, but there was also like no rate inflation. So how is that even possible? You're telling me that the supply-demand curve is out of whack, but the rates stayed the same for literally like 5 years until this last year when everything kind of blew up.
Right. Like what does it mean to say that in 2014 or 2015 we were short 50,000 drivers?
Yeah, no.
Does anyone think that?
No, I think a lot of it is kind of a piling on. The freight markets in general in the last year have really kind of gone haywire.
Right.
But if there was a true driver shortage for the last like 5 years, rates would have reflected that. You would have seen this like gradual increase but they haven't been doing that until just recently.
And to be fair to Bob Costello, he used this phrase which I thought was brilliant. He's like, what we have is like basically free agency in trucking. Like that's really the issue. It's because drivers can, they're already like sort of moving all around the country, doing their own thing. Like almost nothing is stopping them from jumping to another company, and they do that. Whether it's they like the dispatchers better, or they get home more, or they get paid more, they get a new truck. Like there's so many things. Like, and it's almost like with driver retention. We can bring that turnover number down some, but even in like I was looking at this chart, even in like 2009, it was still 50%.
Yeah.
So I mean, that's 2000. That has to be the very bottom
You would
it
think,
could ever go.
Yeah, you would have thought that in these recessionary
Like
economies.
in 2009, no one is just like quitting their job.
No, they were let
Right,
go.
and so 50% is as low as it can ever go. I mean, does that make sense to you?
Yeah, no, I think you're in the right direction. The thinking about it in terms of like the broader economy and the supply and demand of drivers, like you would just expect that in the most recent bottom that we've had, it would be driver demand was just gone. Like,
Right.
We didn't have a driver shortage in 2009, but
Right.
they still were able to just walk out the door and go down the street. So driver
50%. Yeah. 50% is horrific for any other industry.
What other industry has this kind of turnover? I mean, and it's because they know they're going to have a job tomorrow. They're almost like, a lot of them are almost contract laborers.
Yeah.
They kind of come and go in spaces when they'll
drive for 6 months, take a couple months off, start driving a truck again for somebody else.
Exactly. So even in these periods of recession and the economy downturns, like drivers still feel like they have the leverage to walk out the door, and that's weird to me.
It's fascinating.
Yeah.
The other thing I think we should talk about, I mean, we sat through a lot of stuff about tax reform, various sorts of state vehicle sales taxes, exemptions with that, how that works. That was, sort of.
Trump
it was a fairly, I would say, opaque and demoralizing presentation. But it reminds us why tax professionals exist.
Yeah.
Right?
No.
There was one stat that I thought was pretty interesting. It's something that I don't think we've talked about enough, and it's the depreciation write-offs in the new tax reform. Can you sort of explain what that looks like? Just in simple terms?
Yeah, so previously you could only take 80% of the depreciation, like in year one, forward. So what that means basically is you can only write off, you have up to 80% that you could write off, and now you can write off 100% of it.
So you buy an asset, it slowly depreciates, and as that asset loses value, you get to deduct that essentially from your tax, right?
Yeah, and what the way this works in trucking is because trucking companies are notoriously cash poor entities.
Right.
So they need a way to manage their cash flow and accounting effectively. So what they can do is they're basically just deferring this expense until a later period of time so they can manage their existing, so they don't have to pay for it all at once. Because that'll cripple their books. If you go out, you need to have some sort of incentive to go out and make these larger purchases, these capital expenditure purchases that are very expensive.
Right.
And to encourage that, you need to give them a reason to do it. You can't punish them for wanting to grow.
And so, we've covered, what's ACT research, FTR research, people who talk about new truck orders, charting that. June was a record month for new truck orders. So, over 42,000 power units ordered. The OEMs have backlogs that are lengthening, 8-9 months. People are, all of the trucks ordered for the rest of this year aren't going to be delivered until sometime next year.
Yeah, that's insane to me because you're literally making all these purchases and you don't know what the economy or the freight markets are going to be like next year.
Right.
You're basically banking that you're going to have this shortage for the next 12 months. I mean, that's
it's a serious bet. At the same time, our used trucking price indicators are staying firm. So I mean that tells me that as these fleets are buying, at least ordering trucks, we know that the delivery pipeline for these manufacturers is operating at full capacity. But basically they're not. It's not the case that there's a glut of used trucks hitting the market when their tractors get replaced. They're getting bought up.
Exactly.
Evenly.
You're seeing a very heightened cycle of purchase.
Right, but one of the things that I don't think we talk about enough on freight, we talk about the fact that Trump lowered the corporate tax rate, carriers have more cash to buy things, but we don't talk about but they're also writing off all of the depreciation, as soon as they buy it. And do you think that how much does that incentivize these buys?
I think it definitely helps. The economy itself. The economy itself is the main reason, obviously. These guys are making a lot of money over the last 12 months, more so than they've been over the previous 10 years in any given year, except for maybe 2014. But so it's kind of encouraged this spending spree. So they're taking advantage of a bump in the economy. Now, what it means for the economy moving forward, I hope that they have some sort of insight, that they know. Obviously looking at a lot of indicators, it looks like
it's hard to tell. People have been nervous about the end of this cycle for 6 months.
Yeah, and what does that look like? What does the cycle end look like? Is it just a quick little hit like we had in 2016? We had a slow little cooling period,
right?
And so maybe you just ride through a little period of cooling, and then we go right back to where we were.
Right.
Nobody knows what that looks like yet, but the trucking companies themselves are. The trucking companies themselves are actually saying that, hey, we have faith in the economy moving forward.
John Larkin from Stifel just stopped by, so we're just saying hi. Anyway, I think lunch is over. We haven't eaten.
Yeah, we should eat.
We ain't drinking beer because there's way too many numbers to memorize. So let's wrap this up and do some interviews a little bit later on.
All right, let's do it.
All right. Thanks for listening to this bonus episode of What the Truck at the McLeod CFO Conference in Nashville. Make sure you subscribe to What the Truck on Apple Podcasts, Stitcher, or Spotify, and rate and review us so that more listeners can find the show. And if you're interested in even more FreightWaves content on the finance and economics of freight, you don't want to miss MarketWaves 18, our conference at the Gaylord Texan Resort and Convention Center in Grapevine, Texas this November. Visit marketwaves18.com for more information about this event. Well, that'll do it for today, and we'll catch you next time on What the Truck.